Hello everybody, this is Louis from LoukProp and welcome to another episode of Real Talk with LoukProp. Now imagine this, you have been researching a property for a very long time, you love it, your family loves it, it fits everything you need in your ideal home. You send in a loan application to the bank and what happens? It gets rejected. What now? Okay, what do you do in this situation? So in today's video, we'll be discussing 3 different methods that you can do to improve your situation and get you the loan that you need. Let's go. So before we get into the methods proper, let's take a look at how banks assess your loan eligibility. The first thing they'll always look at is your total debt servicing ratio, in short TDSR. So what is TDSR? Basically, your monthly debt obligations, including your mortgage loan, your car loan, your credit card bills, so on and so forth, cannot exceed 60% of your monthly gross income. Right. Next, you have to use 3.5% interest rate as required by MAS ruling, and also a maximum loan tenure of 30 years or up to an age of 65 years old, whichever is lesser, based on the income weighted average age. So with all these parameters, the bank will then assess your maximum loan eligibility. Now with that out of the way, let's go into the methods proper. Now the first way is to decrease your debt obligations comfortably. So whatever debt obligations you have right now, including your credit card bills, credit card personal loans, or your car loan, so on and so forth, if you can pay it off, just pay it off. Right? This not only allows you to have a higher loan eligibility, but also improves your credit score as well. Also, if you have a lot of credit cards that you are no longer using, please go ahead and cancel them off. Because for most banks and even the credit bureau, once they see that you have a lot of credit cards on hand, they may see it as over-leveraging on your part, which might affect your credit score and also affect the loan that you're able to get. For people who are aiming for a second property and your first property still has an amount of loan left, the second property's maximum loan you can get is up to 45%. So if your first property, you're able to comfortably clear off the loan and you do it, your second property can actually bump up the loan up to 75%. Second method is this: increasing your monthly income recognition from the bank side using things like variable income or financial assets. So if you have variable income such as rental income, the bank will be able to recognize 70% of its value towards calculating your monthly income. Things like financial assets, for example, securities like stocks, gold, unit trust, all this can also be utilized in increasing your monthly income as well. But do take note, some banks may not recognize 100% of their value towards calculating your monthly income. So for the last method, we are talking about pledging or unpledging of funds or assets. So for pledging, it is essentially pledging an amount of funds or asset under the bank for at least 4 years as collateral for them to be able to increase your loan amount. So you can use liquid assets like cash, which banks recognize 100% of its value, or securities like stocks, gold, unit trust, but do take note that most banks don't recognize 100% of the value for all these securities and might have a haircut in their value. Now for unpledging, you basically just have to show funds to the bank to get an increased loan amount. But because it is just a showing of funds, you have to show a higher amount of funds. You have to show it twice, once during loan application and once just before loan disbursement. To illustrate this pledging and unpledging, let's take a look at an example. Say if you were to take a $1.5 million loan. Alright, you need to take this loan, but your loan eligibility is only up to 1.4 million. So how do you get the extra 100k of loan? So this 100k of loan, if you were to use a TDSR calculation as an example, 3.5% interest rate as required by MAS ruling, and assuming that you're taking a 30 years loan, the extra income that you would have to have is about $748 per month. Now if we were to take a pledging of 4 years, we'll have to take this extra income of $748 per month and multiply it by 48 months, which gives you $36,000. This $36,000 is exactly the amount that you need to pledge to the bank via things like maybe through cash, alright, as a fixed deposit in the bank's fixed deposit to be able to get an additional 100k of loan. Now, if you want to do by unpledging method, what you have to do is to take this $36,000 and divide by 30%, which gives you a total of 120k that you have to show to the bank in order to get an additional 100k of loan eligibility. So this is an example and difference between pledging and unpledging, whereby unpledging will require a higher amount to show to the bank in order to get that same amount of loan increment. Do take note that not all banks will accept pledging and unpledging as a way to get an increased loan, right? So do check with your bankers or property agents if you want to get the relevant info or calculations. So with all the methods being said, we still encourage prudent planning of your financials in order to make your purchase a comfortable one. So whatever methods that you employ, please make sure that these are all within your means and not overstretching yourself. So do you have any other methods that we haven't discussed? Leave it down in the comment section below. Now subscribe to the channel and please help to like the video because it will help the channel out a lot. Yeah, I was going to tell you a bank joke, but I lost interest. Now I'm going to leave you alone.
I've been watching you, a la 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 long, a la 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 long, 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 long. Come on, a la 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 long, a la.